Why 90% of beginners lose money in their first year of investing. What if I told you that the biggest threat to your investments isn't a market crash, isn't a recession, and isn't even a bad stock pick? It's actually something much simpler and much more dangerous because it's invisible. It's you. More specifically, the decisions you make in your very first year of investing. Statistically, most beginners lose money or barely break even in year one, and it's almost never because the market did something crazy. Today, I'm going to walk you through exactly why that happens, the specific mistakes behind it, and how you can avoid becoming part of that statistic. Welcome to Verse, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. The problem nobody talks about. All right, let's start with the uncomfortable truth. When people imagine investing, they imagine picking the right stock, timing the market perfectly, and watching their money multiply. But here's what actually happens for most beginners. They open an account with excitement, they put in some money, and within a few months they've either panic sold at a loss, jumped into something risky because a friend mentioned it, or just froze completely and let their money sit in cash doing nothing. None of these people are unintelligent. None of them are lazy. The problem isn't their intelligence. The problem is that nobody explained the psychological side of investing to them. And that's exactly what we're going to fix today. Think of it like this. Imagine going grocery shopping without a list while you're hungry. You end up throwing random things into your cart, some useful, some not, and you leave having spent more than you planned on things you didn't actually need. That's what most beginners do with their money. They open a brokerage account, see a stock trending on social media, and buy it without asking themselves the most important question. What is this money actually for? Is it for retirement in 30 years? Is it for a house in 5 years? Because the answer to that question changes everything about how you should invest. If you don't know your timeline and your goal, you have no way to judge whether a decision is good or bad. You're just reacting to noise. And that brings us straight into mistake number two. This is, without question, the number one wealth destroyer for beginners. Not fees, not bad picks, emotions. Here's how it usually plays out. The market goes up and you feel excited, so you buy more, often near the top. Then the market drops 10 or 15%, and suddenly that excitement turns into panic. You start checking your portfolio 5 times a day. You can't sleep. And eventually you sell, locking in a loss that would have recovered if you'd just done nothing. I want you to really sit with that for a second because it's counterintuitive. The investors who do the worst aren't usually the ones who pick bad stocks. They're the ones who buy high out of greed and sell low out of fear. It's the exact opposite of what you're supposed to do, and it happens because our brains are wired for survival, not for long-term investing. When something feels threatening, we run. But in the stock market, running is usually the worst possible move. Mistake number three, chasing hype. Now let's talk about something we see constantly on social media. A stock, a coin, or some new trend is exploding in price. Everyone's talking about it, and beginners feel like they're missing out if they don't jump in immediately. This is called FOMO, fear of missing out, and it is responsible for an enormous amount of beginner losses. Here's the uncomfortable math behind it. By the time something is trending enough for the average beginner to hear about it, the early, easy gains have almost always already happened. What's left is usually the risky part of the move, the part where prices are stretched far beyond what the underlying business or asset is actually worth. And when that hype fades, and it always eventually does, the people who bought in late are the ones left holding the losses. Mistake number four, no emergency fund. This one surprises a lot of people because it doesn't even seem related to investing at first. But here's the thing. If you don't have cash set aside for emergencies and your car breaks down or you lose your job, guess where that money has to come from? Your investments. And that means you're forced to sell, sometimes at exactly the wrong moment, not because it was a smart financial decision, but because you had no choice. This is why having 6 to 12 months of expenses saved before you go all in on investing isn't boring advice. It's actually protecting your future gains. It keeps you from being forced out of the market at the worst possible time. Mistake number 5, trying to time the market. I want to be really honest with you here. Even professional fund managers, people who do this for a living, with entire research teams behind them, consistently fail to time the market. So when a beginner tries to guess the perfect moment to buy low and sell high, based on a gut feeling or a headline they saw, the odds are stacked heavily against them. Trying to time the market isn't really investing, it's speculation dressed up as strategy, and the data backs this up again and again. Missing just the 10 best trading days over a 20-year period can cut your total returns by more than half, and nobody, not even professionals, can reliably predict exactly which days those will be. So, what's the actual insight here? Here's what I want you to take away from all of this. Every single mistake we just covered has the exact same root cause. Beginners treat investing like a short-term game when it's actually a long-term system. The market rewards patience and punishes impulsiveness. That's not a coincidence. That's the entire mechanism by which long-term investors end up outperforming people who trade constantly based on emotion. Once you internalize that, the solutions become pretty straightforward. The solutions, step-by-step: number 1, define your goal and your timeline before you invest a single dollar. Write it down if you have to. Retirement in 30 years needs a completely different approach than a down payment you need in 2 years. Number 2, build your emergency fund first. 6 to 12 months of expenses in cash sitting in a separate account you don't touch. This single step removes the number 1 reason people are forced to sell at a loss. Number 3, automate your investing. Set up automatic transfers into a diversified, low-cost investment like an index fund every single month, regardless of what the market is doing. This does 2 powerful things. It removes emotion from the equation, because you're not deciding when to buy based on how you feel, and it takes advantage of a strategy called dollar-cost averaging, which smooths out the ups and downs over time. Number 4, stop checking your portfolio every day. I know that sounds strange coming from a finance channel, but hear me out. The more often you check your investments, the more emotional decisions you're likely to make. Checking daily shows you noise. Checking quarterly or yearly shows you the actual trend. Number 5, ignore the hype. If something is trending everywhere on social media, that's usually a signal to be cautious, not a signal to jump in. Boring, diversified, long-term investing isn't exciting, but it's what actually works. A quick example to make this real. Let's say 2 people each start investing $500 a month at the same time. Investor A checks the market constantly, panics during every dip, sells, waits for things to feel safe again, then buys back in, usually after prices have already gone back up. Investor B sets up an automatic transfer, invests in a diversified index fund, and literally never looks at it except once a year. Over 10 years, assuming the same average market return, Investor B almost always ends up significantly ahead, sometimes by tens of thousands of dollars, purely because Investor A's emotional decisions cause them to buy high and sell low over and over again. Same market, same starting amount, completely different outcome, all because of behavior, not knowledge. Bringing it all together. So why do 90% of beginners lose money or underperform in their first year? It's almost never because the market crashed, and it's almost never because they picked a terrible investment. It's because investing without a plan, without an emergency fund, and without emotional discipline turns a long-term wealth-building tool into a short-term guessing game. The good news is none of the fixes we talked about today require special knowledge or a finance degree. They require a plan, some patience, and a system that removes emotion from the process. If you can do that, you're already ahead of the vast majority of beginners out there. If you found this video helpful, I would really appreciate it if you liked it and subscribed to Mavic Finance, where we upload investing videos every week. And if you're curious about how compound interest actually multiplies these good habits over time, I have a video on that I think you'll really enjoy. I'll leave it right here. Thanks for watching and see you very soon. Bye.